Hi, welcome to another Super Macro podcast. My name is Elvis. Opposite me is Jonny Matthews, a heart and soul of Super Macro. Hi, Jonny.
Hi, Elvis.
Jonny, same as last time. The market's testing your conviction that we're not going to get a recession. Have you amended your view? Have you changed your view? If not, why? And tell us what's going on.
No, it's still just as strong. I don't think we're going to get a recession. Clearly, it's a non-consensus view, and but that's how you make money.
There's less and less of you in that pond, isn't there?
Absolutely, it's getting to be a tougher view to defend.
Okay, Jonny. Tell us why the market's wrong. Tell us why the rates market is wrong. What have you got for us?
Yes, certainly, Elvis. Okay, well, I've got a whole chart deck here today. I want to start off talking about the Fed and the market reaction to the Fed, because this is a very, very dovish Fed. And I'm going to show that on the first chart. So what I'm showing here is the changes in the two-year yield on the day of each FOMC meeting, going back to when they did the first hike in March of 2022. And on that day, the two-year yield went up, but it went up to something like 1.9 something percent. Since then, it went above 5%. It started coming down a bit recently, but the general trend over the 2 years was for the two-year yield to go up. So on average, it went up a bit each day. But on each day that the FOMC met, and that's what I'm showing in this chart, these are FOMC meeting days, Powell with his press conference and the dot plot projections on what they thought was going to happen to the economy with rates, with inflation declining, they managed to send the yield on the two-year note sharply lower. On many occasions, it was more than 20 basis points lower by the time they'd finished talking. So you've got to bear in mind, the Fed really got it very, very wrong throughout that period, kept on predicting inflation was going to be transitory and that they wouldn't have to hike rates that far. And then we got to a point in December of last year where there was the famous Powell pivot, and you can see that on that particular day, the biggest green bar.
This is as good as a representation of how the Fed thinks and how dovish they are, just by looking at on the green lines on this chart. No.
Well, yeah. This is just on the meeting days. They're managing to drive the yield on the two-year note sharply lower during a period when it was going higher, but each time they met, they drove it back down again. And then, of course, circumstances and the market conspired against them, and the yields just kept going up. But that's Powell pivot at the end of last year. We can see the two-year yield dropped 30 basis points on that day.
It's a huge move.
Yeah. But it dropped 30 basis points on that day. And the dot plot from the FOMC had penciled in 3 rate cuts for this year. And the market went pretty crazy. The market, after that, then priced in something like 170 basis points of cutting for this year.
That was a max they priced in. Yeah.
And that was early in the year, something like January. Then throughout the year, it went down and down until it was, down
well, the first quarter's worth of economic data was quite strong, wasn't it?
Yeah, it was. Yeah, not only the economic data was strong, the inflation prints were higher than expected. So by the summer, the market was pricing just one rate cut this year. So the market has a tendency to over-exaggerate these moves. But the other important thing that you can see is that prior to this most recent meeting, the prior 7 meetings, on each occasion, Powell drove the yield on the two-year note lower. It got to such a low level at this most recent meeting when they actually pulled the trigger on a 50 basis point cut, that by the close of the meeting, the yield just ticked up a little higher.
The market done the work for him.
Yeah, there was nowhere else for it to go.
Yeah.
And I think that's the kind of situation we're in now where, well, first of all, I don't think there's going to be a recession. But secondly, even if there is a mild recession, an economic slowdown, a mild recession, a couple of quarters of negative growth, I think the market has more than priced in whatever response it will get from the Fed.
Okay, Johnny, no recession. You don't think it's going to be a recession. What data have you got to support that theory? And what have you got to show us today?
Well, the recent data that we've had, a lot of the hard data, the actual hard numbers that we've got, are still running reasonably at a reasonably firm rate. Granted, job growth has slowed, and economists, the market tends to think that job growth, once it slows, it very soon goes to zero and then turns negative. You start getting job losses. But I can't see why on earth companies will start cutting jobs. Consumers are still freely spending. Corporate profits grew something like 10 or 11% year over year in Q2, probably at a similar pace in Q3. And I just don't see why the demand for labor should suddenly fall off a cliff.
Just on that one of those points you made, corporate profits expected to grow by I think it's 8% Q2 to Q3 year on year, correct?
I believe so. Yeah. From memory, yeah.
FedEx had a bit of a, I can't say the word
hiccup.
Hiccup. I say the word hiccup. Do you think that that's the broader economy that they're showing us, or is it just the fact that maybe? I seem to remember after the pandemic, they really geared up and then got caught cold when we shifted the services from goods demand.
Yeah, goods purchases. Yeah, well, look, I think it's the same thing today. You can't take any one company as indicative of the health of the economy. In fact, it's very difficult to take even a collection of corporate earnings and sift through the commentary and draw any firm conclusions.
Right.
So you've got to be very careful, especially with an individual company.
But it's something to be aware of rather than something to sit there and actively trade prior to the data coming out.
Absolutely.
Okay.
So, look, I already said consumer spending growth was strong. We at the start of this quarter, so we've only had 1 month of real consumption spending so far of this quarter. We've had the July data.
Right.
This Friday, we're going to get the August data. But July's spending, the rate of spending in July, was so far above the run rate during Q2, the average monthly run rate in Q2, that even with no further increases in consumption, Q3 consumption growth will be at a rate of 3%, an annualized rate of 3%. So let me just be clear about that. July was so strong. There doesn't need to be any further growth in August or September, and we're already going to have a strong quarter of consumption growth.
So why is the rates market ignoring this consumption growth that you telling us it's so strong?
Well, I think obviously, there's plenty of commentary about a recession coming and about there's fears over unemployment rising and so on. But I just don't think there is a valid justification for those fears.
So you're saying the survey data's, what's the word I'm looking for? I wouldn't say wrong, but it's not something you should necessarily...
Can't read too much into soft data like surveys. No. Look, with the most recent data that we had, last week we had retail sales. That's a small part of consumption. Well, it's a big part of consumption. It represents about 40% of consumption. Retail sales, core retail sales, grew in August by 0.3%. That's a reasonable amount. And that suggests that nominal consumption, certainly nominal consumption of goods, will grow at a similar kind of rate when we get the numbers on Friday. So retail sales growth, in fact, over the last 3 months has been going at an annualized rate of something like 6.5%. So retail sales are still very, very firm. So I'm confident that we're going to get another strong quarter of consumption growth, somewhere near 3%. Now let's just look at the next chart. Sorry. So this is the Atlanta Fed GDP Now forecast. Now, the Atlanta Fed did a brilliant job of estimating Q2 growth.
Right.
It gets more and more accurate as you come towards the time when you actually get the release of the print. But based on the data that we've got, the hard data that we've got, Q3 growth is on track to run at about 2.9%, according to the Atlanta Fed, primarily because of very strong consumption growth.
That's real.
That's real, real consumption growth, which comprises most of GDP. And you can see, the contributions to Q3 growth based on the data that we've got so far, primarily personal consumption expenditures, which is, what you should expect. And then the rest, there's contributions from fixed asset investment, business investment, government spending, and
you don't want government spending to be too big a part of this, because that can turn off as quick as it turns on.
Yeah, we're not relying on.
You want cyclical stuff, which is the consumer spending, opening what it's spending, and continue to spend.
Well, that and business equipment investment and intellectual property investment. So that looks to be in place at the moment, and I can't see a reason why that will suddenly fall off a cliff.
Okay, number one reason. Okay.
Number one reason. Okay, now
fine,
let's talk a little bit about the job market.
Okay. Oh, yeah.
So this next chart, we get weekly jobless claims.
So this is to be clear, is the only real-time up-to-date indicator of the jobs market, much more up-to-date than even the non-farm payrolls.
Well, it's weekly, so it's near real time, and it's a count of layoff announcements, basically. So we get it each week, and we can look at the trends there. There's two numbers that are released. One is initial jobless claims, which is the people that have recently been let go, the number of people recently let go. And if they don't find work within a week, they become continuing claims until they find a new job. So the stock of continuing claims, which is the blue line in this chart, gives a good guide to the pace to unemployment.
How quickly they're finding another job, in other words.
Yeah. It's kind of the stock of unemployed people. It's another measure of the number of unemployed people. And in this chart, the blue line is advanced by 3 months. And the point is, this is on a very broad scale. This is, 24 years worth of it. So it's advanced by 3 months. And you can see it's kind of, it ticked up a bit during the summer, and now it's come down again.
Don't look like recession to me from this chart.
No, it's kind of flatlining, but the unemployment rate in the red line did go higher. It ticked down in the most recent monthly print. And it may be exaggerating the weakness in the labour market.
Is that because I think you've explained this before, the immigration has added to the actual total size of the workforce, therefore bringing up the unemployment rate?
Yeah, put simply, new immigrants to the country, they don't start off with a job in many cases. They start off looking for work, so they join the unemployment rolls.
Understand. Okay, understood rather.
So that's the first chart.
Okay, number two, that's the second reason why. So the jobs market remains fairly tight and in decent shape.
Look, I've got to be honest, there's certainly indications it's nowhere near as tight as it was.
Using those two measures.
But on that basis, it's not falling apart.
Right.
It's really not falling apart. This next chart, I really just wanted to put up a chart of the Fed's dot plot and look at it in a little more detail. And what I'm showing here is basically every time the FOMC meets at the quarterly meetings, the officials that attend, there's 19 officials, and each one gets to say what their estimate of the year-end Fed funds rate will be.
Voter or not voter, doesn't make any odds.
Regardless of whether they're voters or not. So 7 of them don't even get a vote. They all get to say where they think the Fed funds rate will be at the end of the year. And if you look at this, obviously for 2024, quite 9 of them are in agreement at 4.375 for the end of the year, which is fine. That's 100 basis points of cuts, which we're going to get. We've had 50, we're going to get another.
Get 2 lots of 25s, and that does us for the year.
Yep. So they're in broad agreement there. If you look at 2025, they're all over the shop. There's 2 that think the rate should be 2.875, 1 that thinks it should be 4.125. We don't know which ones are voters and which ones aren't. I could take a guess at who that 1 is at 4.125.
Yeah, that's probably.
Yeah,
Bowman.
that's Michelle Bowman.
Yeah.
And then you've got 15 of them that are between 3.125 and 3.625. The median rate 3.375.
It's another 100 basis points.
Yeah. And then
do you see that being front loaded on the year? For instance, January, I assume there was one in March.
There's a meeting in January, and I think a meeting in March. I have no idea the distribution. I think it really will depend on the data. If the labour market does fall off a cliff, then they'll be quicker. Yeah, they'll be a lot quicker. But the point is, they don't know what they're going to do. It's quite clear they don't really have a firm idea of what they're going to do in 2025. Or in the later years.
Going out further, it gets even more. The distribution is even wider.
Yeah. Which is reasonable. I mean, who the hell knows, really?
Yeah.
And so that's a more honest look at Fed opinion on the rates. But the market, as far as the market's concerned, now on this chart here, I'm showing the dots are the median expected rate from that FO from
that's
this
that's the red X's.
Yeah, the median expected rate. From this most recent FOMC meeting. And the blue line is what the SOFR futures are pricing. Yeah. So you can see for this year, the SOFR futures for December 2025, we know the median Fed funds expected rate, 3.375, call it 3.4%. The market is pricing a rate below 3%.
285, I think it was yesterday, but I'm not sure what it is today. But I haven't looked at the same.
Yeah, quite possibly.
So about 50 basis points lower than the Fed's projecting in the SEPs.
Yeah, the summary of economic projections. Yeah, absolutely. And I'm not convinced that the Fed will get that far with the rate cutting cycle anyway, because I'm not convinced that the economy is going to slow as fast as the Fed expects.
Let me be clear about this. You think the Fed's already their projections in the SEP or the summary of economic projections is maybe too low for how solid the economy is in the US, and the market's then pricing in another 50 basis points on top of the SEPs in terms of what they're going to cut by.
That's it.
So the market's doubly wrong for the sake of it.
Yeah. It's like I said, I don't think there's a lot of money to be made by betting that rates will be lower than they are already priced.
Well, give me a trigger then for the market to change its mind, because the market can change its mind literally instantaneously, and those SEPs will say the same until they update them. The market can change overnight.
Well, for sure.
What's the trigger then?
Well, I can almost guarantee that we get a strong payroll print early in October. The September payroll print, if that's strong, I'm not saying I've got no idea what it will be, but a much stronger than expected payroll print, then that'll be it. It'll be game over for
what
these
about
rates
unemployment print sub 4%?
Well, it's part and parcel of the same thing. Yeah,
but they're two different surveys, though, aren't they?
Yes, they are. The payroll print is the more accurate survey. The level of accuracy in that, even though it's subject to big revision,
just the 800,000 revision on that one.
But you've got to look at all the data that gets released on that day. And the other factor will be the pace of average hourly earnings. And let's put it this way: average hourly earnings are still growing at. I don't remember the last print, something like 4%. You've got inflation that's now headline inflation, which is what counts for people for people, the dollar in their pocket, which is down 2.5% or so. And we just had another strong decline in gasoline prices, which puts more discretionary spending power into consumers' pockets. So I do think the economy is going to be in pretty good health going forward.
Thanks you for those justifications to why you don't think we're going into recession. But inflation, what are you thinking longer term in inflation? And if you've got anything to back it up slide-wise?
It's like I said on the last show, no one's really brilliant at forecasting inflation. But I do feel that the period that we went through in the post-GFC period anyway, when inflation was incredibly low and central banks were worried about a period of deflation, I don't think that's going to return anytime soon. And
is it? I'm going to ask you. I know it's a question you don't like talking about politics, but we've got a pretty big election coming up in November, and if we get Mr. Trump in, my suspicions are that inflation, will at least be priced higher. Whether or not it will go higher initially, it will start getting priced into markets because of what his policies are: immigration, tariffs, etc. That's going to be a big factor going forward.
Yeah, I think depending on if he does actually go ahead with the kind of tariff increases that he's threatened, quite often, don't forget, he's playing to the gallery when he talks about putting 100% tariffs on Chinese products.
But no one's complaining about this, are they? At the moment, he's there. China's an easy target, and so's the European trading partners are an easy target for them.
Yeah, certainly. If he does get in, tariffs will be increased, and we can. I read earlier today the last round of tariffs, which weren't that high in the end. The additional tariffs, the average tariff increase wasn't that high, but it did have an impact on prices, and without a doubt, if the tariffs are increased by 10% even, it'll have an impact on prices. And like you say, if there's much less immigration, there's less supply of labor, it should push up all other things equal. It should push up the cost of labor.
On top of the onshoring we've already had from a lot of the deglobalization.
Yeah, plus the large fiscal deficits that will keep on going.
Ooh, yes, those little things, yes.
So neither candidate is going to rein in fiscal spending. So from a longer term perspective,
what we've got here.
From a longer term
gold.
perspective, I want to just look at the contrast between the period prior to the pandemic and the post-pandemic period. Prior to the pandemic, that red line is the consumer price index, and that went up at a rate between somewhere between 1% and 2% a year, a fairly steady, slow rate of increase. And gold kept track with that. Gold was increased roughly in line with the increases in the consumer price index. And if you were invested in treasuries, you also got a return roughly in line with the rate of consumer price inflation.
So hunky-dory.
Yeah, except you haven't got any real return out of that. You just got zero each year in real terms. Then when the pandemic hit and the Fed went crazy with taking rates down to virtually zero, all the QE, the government issued all the stimulus checks and ramped up fiscal spending elsewhere. Suddenly we got this, well, not suddenly, it took a little while, but it didn't take long. We got this surge in inflation, and gold really took off at that point. And you can see that initial burst during 2020.
That's an interesting chart, isn't it? You can see that from what I'm sitting here, the treasuries initially picked up on the lower rates, but then when the market got the willies about the fact how much they actually going to be spending and its inflationary aspects of that, gold took off and the treasuries underperformed.
Well, yes, gold took off, and then obviously treasuries rallied from the rate cuts. The rates were taken down to zero, and the long end of the curve, I mean, the 10-year yield dropped below 1%, got down to close to 50 basis points, I believe. So treasuries had a very good rally until it became clear that this whole procedure was going to usher in much higher inflation. So then the Fed started hiking. Well, actually, we got the increase in inflation first. You can see the CPI starts going up quite aggressively from 2021 onwards. The slope really increases. The consumer price increases are really accelerating. Treasuries take it on the chin. The Fed starts hiking and gold goes sideways for a few years.
Yeah.
And then now, since the end of 2023, the Fed pivot, gold really took off.
Looks like gold's pricing in a lot of inflation already, where we're not really seeing that in other data that's coming out.
I think there's two things here. Gold has proved itself as a reliable store of value.
Yeah.
You're not, unless you're really good at timing, you're not really going to make a fortune by diving in and out of the gold market. But it just holds its value very well over time.
So as part of a portfolio, it's something you've got to own.
Yeah, I think so. I think it makes sense to have a position in gold. But if you look over the last 10 years and you look at the performance of treasuries, you've really lost quite a lot there in real terms. The consumer price index is up 20% or so. Your return from the treasury market, you've made a nominal return of 10%.
This is a lot of it is post the GFC and the unproductive investment, and with the quantitative easing when they held rates down and forced people to buy these treasuries with ultra low coupons, and you could say it's partly to do with the starting point. Well, you could say it's partly to do with the starting point, but I think there's two separate periods in this. There's the post GFC period up until the pandemic, when inflation was low, rates were low, and the treasury market kept pace with inflation in real terms. And then the post-pandemic period, when this burst of inflation was unleashed, and you've been much better off owning gold. And my point is not really to say, well, I think gold's a great investment or anything like that. I'm just pointing out that I don't think we're going back into that pre-pandemic period of ultra low inflation, ultra low rates, and pancake flat yield curves. That was the anomaly. This is now a different environment. Okay. Well, you've presented a lot of reasons why you have your theory that there's not going to be a recession. Now tell us, how do we make money out of this? I take it there's more attractive trades now that the market's still very aggressively against you.
I'm not recommending trades to anyone. My portfolio, which I write about in Super Macro every week.
www.super-macro.com.
Yep, super-macro.com. That's and you can see now I've got some sterling calls for reasons which I've discussed previously. Those are doing very well. I've got some basic resources.
Oh, you got lucky on that, didn't
I
you?
got very lucky,
yes.
thanks to the Chinese.
Yes,
so
thank you so
basic
much.
resources ETF has done very well since I put the trade on. But better lucky than good. And I am short rates. By that, I'm short Treasury futures and I'm short SOFR futures.
So the rates trade's been, I want to say, I don't want to put it in sugarcoat it. It's been a struggle recently to
it's
get
been a struggle.
in.
Look, I only put the trade on in relatively small size a short while ago. So the DEC 25 SOFR futures, they've been drifting between being onside and offside over the last few weeks. The Treasury futures, they're down. I'm offside a small amount, but I'm confident that these are the right positions. I'm not gonna say I'm not gonna change my view if I'm completely wrong. If we start getting negative payroll prints, then certainly I'm wrong.
Well, okay, so we get a half decent payroll print. That's tomorrow. That's Friday week. Will you ramp up your size?
Yes, absolutely.
That's the way to do it, isn't it?
I
really?
think it is. I think the
market gets told, the rates market gets told, maybe we're wrong on this one. We need to change our horizon.
I mean, right now where we are in the rates market, I think the market has priced in as much bad news as we're likely to get.
Yeah.
And I think going forward, I think rates
So
will
risk
be higher.
reward. See, the risk reward to you is priced to be short rates.
Yeah, that's it. That's it.
Okay.
Well, I think that's it.
Thanks, Johnny. Perfect.
right.
Till next time.
Yep.
By the way,
Thank you,
where's the
Elvis.
whiskey? We had whiskey last time, didn't we?
Yeah,
I
we
don't
did.
remember. Is this a cheap version?
Well, it's too early in the week.
Never too early for whiskey or bourbon in my case. Thank you all.